The markets are open and it is looking like a rebound to close the week, and the company in the spotlight today is Apple, which is up more than 1%. But when we do zoom out to even just this last week, we see many companies deep down into the red, and Apple itself is down nearly 11%. We also notice investor sentiment is still sitting in extreme fear, many still worried about the implications of the trade war and how it will affect the wider economy. And today our focus on Apple, the Mag 7 giant, which is currently sitting around 20% lower than its all-time highs, but also in the mid, moving to the lower end of the 52-week range with just one buy rating from Wall Street. Now, they do pay a dividend, although on the very trivial end at 0.5%, and over the last year, they're up 22%. Year to date, the company has been hammered negative 15%, but over the last 10 years, as many of you would know, it has massively outperformed the S&P, up 566%. It does also trade at a forward P valuation of 28.6. Now, we just want to start off by saying institutional ownership sits at around 68%, 144 billion worth of sales over the last year, but we do get a lot more buying in the same time frame at 210 billion, and we also notice just in the most recent quarter, institutions bought around twice as much as they have sold, so they are clearly very bullish on this company. However, one well-known super investor may not be as bullish, and that is Warren Buffett, who right now does hold a very large portion of his portfolio in the company at 28%, but this is one he has been selling out of over the last few quarters, and as we will come to show you, in the most recent quarter, actually it did remain untouched. But if we go to Q3 of 2024, we can see he sold around 25% of his overall position. If we go to Q2, we actually get quite a significant sell-off, around 50%, and we also notice at the beginning of the year in 2024, he sold around 13%. Right now though, as we highlighted, it is his largest position, but rather than take up nearly half of his portfolio, it does sit around 28%. And one thing we always like to do is compare how a company trades against its 5-year average. Right now, Apple is sitting in line at the 28 region, and that is what we would call a reasonable signal, something that is only reinforced when we take a look at this model. Now remember, blue tunnel signaling the fair price of the company. Great to see it increase over time. That is naturally what we want from companies we're invested in, but right now it sits in the midpoint of this blue tunnel, indicating once again a reasonable signal. One thing we would however point out is in comparison to the sector median that sits at 21, Apple right now trades at a premium of 36%, and as we highlighted, pretty much in line with their own 5-year average, something that is reinforced no matter what valuation metric you look at today, whether it's EV to sales, whether it's price to sales, price to book, or even price to cash flow. Apple trades at a substantial premium to the wider market. Now, if we look at their most recent quarter of earnings, we can see Q1 of FY25, they grew their top line at 4% on a year-on-year comparison. That is pretty much in line with inflation. So in real terms, there has been no growth, and we actually notice iPhone sales were down 1%, Mac sales and iPad were very strong, the leaders of their revenue, up 16 and 15% respectively, with watches also down around 2%. But the real highlight of their revenue was the services space, which was up 14% year on year and is actually their second largest revenue stream. We also do get some very small efficiencies on their gross margin, up 1 percentage point, and others the same to note for the operating side as well as their bottom line net income. We also wanted to share this very interesting graphic which basically highlights over time the vast bulk of this company's sales has come from iPhone, which now sits around 52%. If you look at this back in 2007, it was 0.5%, and it has only grown, although over the most recent years we have seen a slight decline. Nonetheless, iPhones is pretty much the biggest driving force for the time being for the company. Now, if we look at that most recent earnings, not in comparison to their own numbers, but what the analysts wanted, we can see they reported $2.40 above the targeted forecast of $2.35. Their revenue also coming in slightly above 124.3, above 124.12. But there are also other metrics that analysts like to look at for some companies. One of them for Apple is their iPhone revenue, which actually they reported a lower number than what the market wanted to see. Mac sales were higher as well as iPad revenue, but we also noticed other product revenues coming in under, with services coming in slightly higher. The other thing that we did highlight earlier was their gross margin not only increasing in comparison to the same quarter last year, but also slightly above the forecast from analysts. Now, in terms of the next 4 quarters, they do anticipate mid to high single digit increase to the EPS year on year. They also have a 100% historical track record, which gives us faith they can hit their September 2025 earnings per share of $7.33, which in turn, as we've already highlighted, means the company is trading at a forward valuation around the 28 point. And one thing you've got to love with this company is their very high return on invested capital, something that only increases over the longer term. We want to see a minimum of 10%, right now 77% on a trailing 12-month basis. And remember, this gives us faith management are able to effectively allocate their capital. In terms of their growth, this is really where the company does seem to struggle. Year on year, 3%, sector is higher at 5%, their own 5-year average higher at 9%, forward-looking 5%, lower than the sector at 6.5%, also lower than their 5-year of 7.2%, and EPS is looking a little bit lackluster, anticipated growth of 11% over the next 3 to 5 years. In comparison, the sector above at 15%, and their own 5-year a little bit higher at 11.2%. Now, you could argue Apple doesn't have a lot going for it in this moment in time. In fact, just recently they confirmed they're delaying their iPhone's personalized Siri. This was something that essentially was sold on the basis of the new phone coming out, the iPhone 16, where they've even started to retract a lot of their adverts, which did talk about all of the services you could use. And unfortunately, this is a delay which will only harm Apple and the consumer's confidence in the company to bring out something that is a little bit more exciting than what we have typically seen. And whilst a precise time hasn't been given, this is something that analysts do believe could be on hold until March 2026, so not even in time for the supposable new iPhone 17 due to be released later in the year. And speaking of growth about this company, maybe one of the reasons why this company isn't as strong as it used to be is because typically their largest revenue stream, as highlighted, their iPhone sales, doesn't really have any innovation coming in, at least over the last few models. With the upcoming 17 Pro, one thing that is really highlighted here is that they have a new advanced calling system for better performance. And honestly, whilst we saw in the most recent iPhone the new camera button, which a lot of people did not like to see, there isn't anything to get excited about, at least in this moment in time. And we can also see this through their sales growth over the last 10 years. It has been very, very inconsistent. Just in the last few years, we've seen 2% in 2024, a decrease to their top line in 2023, and an increase of 8%. Very inconsistent, and maybe this is something that Apple really need to think about, how they can start increasing their revenue, but perhaps a potential new income stream in relation to artificial intelligence. If we look at the profitability, they have an A+, gross margin 47%, below the sector at 50%, but above their own 5-year at 42%. Bottom line, 24%. That is above the sector at 4% and pretty much in line with their own 5-year, so very minimal efficiencies noted. But one thing they continue to do, generate a significant amount of cash from operations, $108 billion, above their own 5-year average of $105 and well above the sector at $104 million. And we can see their operating margin looking very strong, well above the 12% minimum, with some efficiencies going from 30% in 2015 to now sitting at 32%. And as you can very clearly see, this is a free cash flow machine, very consistent in the high 20s, low 30s, and sitting at 25% on a trailing 12-month. In terms of shares outstanding, this is one thing they do quite significantly. Yes, they do pay a dividend, but just look at the number of shares they have bought back over the last 10 years. And remember, this is one way that companies return excess cash to investor pockets. In fact, over the period, they've bought around $8 billion worth of shares. That is a very significant amount. We also have to highlight the net debt to EBITDA, which does correlate to balance sheet strength. We want to see below 3, numbers below the number of years it would take them to pay off all of their debt net of cash on hand. 0.28 over the last 12 months, signaling they have a very strong balance sheet, something we have seen pretty consistently at least over the last 10 years. Now, analysts aren't too pleased about Apple and the way this company is, not just over the last few months, but also expectations moving forward, where at the beginning of this year, they did in fact get a downgrade, and as we did see, analysts not impressed, and the main reason is they have started to fail to inspire confidence, and the artificial intelligence extras, whether that's in their phones or any other products, is just not something that anyone is getting excited about, and we can see in their own words the company has a decidedly unattractive outlook. And what the analyst has effectively done is move this company in fact to a sell from a hold, and even trim their price target to now sit at $188, something which we've seen again in 2025 later on in January, where the forecast for their weak iPhone sales, the weaker updates to the AI, and in fact right now some fresh news in March that they are delaying their phone, just hasn't got any analysts excited, and this one in particular has moved them to underperform from a hold, and they believe you're better off just putting your money into the S&P 500, and they've reduced their price target by 13%, now sitting at $201. Remember, even with the drop we are seeing in the S&P, some companies are still trading at some very high valuations, and you could look at Apple trading around the 26 point, although will depend on which source of information you use, as one that does trade at above maybe an attractive level, or even one that you could say is above its fair valuation. Now, before we jump into our own valuation, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning covering severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to gain access to severely undervalued stocks for the month of March. Lots of information for each one, the upside that Wall Street themselves see over the next year, and also just this morning we released 97 undervalued stocks that Wall Street themselves believe have the most upside right now in the S&P. So click below, you can sign up and read straight away. We now move into our valuation for Apple stock, where we get to $200 derived from the DCF model. Now we will show you how we got there with the most recent free cash flow figure for 2024. Their average growth rate is 7% over the last 10 years. We've gone for 8% moving forwards. As you can see here, we have a low, medium and high. But as always, these numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Apple stock or any others. But based on 8% and the discount rate, we get the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, $200 indicating 6% downside. Now, if you're someone that believes 8% is too low, you believe over the longer term it will grow higher and above their own average, at the 10% point, it comes to $231, and even that isn't too high, around upside of 9%. And then we move on to the 12% upper end that we have gone for today, $266, and there we do see 25%. Now, we will take through the lower rate at 8%. This is probably where we do see this company, at least in this moment in time. And what we typically like to do on the channel is add a margin of safety, where we'd use 10%, execute on that if it met our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. But if you believe that it would be a buy at $180, then you'd keep going until you have the MOS that you want at 20% around $160. Now, we can also show you, for those that perhaps believe 10% is the more appropriate rate, what level of margin of safety you would get at that medium figure. And we can in fact see at 10% MOS, it isn't far, but it isn't there just yet. You would be getting somewhere between 5 to 10%. And Wall Street, no matter what forecast you use, they see this at $255 over the next year, and that translates to 20% upside. Again, we can just end by showing you 12% if you actually believe over the longer term they can in fact grow at a faster rate. And as we would expect, you do get a larger margin of safety, in fact around 20%, if you believe they can grow their free cash flows at the 12% over the longer rate, with the Wall Street's price target remaining untouched. As always though, do give us your thoughts in the below. Is now finally the time to start buying Apple stock? And don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon as well, where we do discuss our weekly buys and sales. And as always, have a great day. We'll see you all on the next one.